A conversation on the market now. Rakshit Ranjan joins us. He's portfolio manager at Marcellus Investment Managers to take some questions. Rakshit, as always, thanks for being here. It's great to have you on the show. You know, my first question to you has to be on the banks because we have been discussing this for a couple of weeks now. From the highs, we've seen an over 5% kind of cut. I mean, even globally, this has sort of been a bit of the pain point, right? How much more pain do you expect over here? Do you think that this will continue to be sort of the sore point for the market going forward as well?
Good morning. Well, thanks first of all for having me on your channel. On the banks, I think at one level, net interest margins are coming off their highs from about a couple of quarters ago. But at the same time, I think the asset quality for the industry as a whole hasn't yet shown any significant signs of deterioration. So there is a possibility that that you might see profit growth of the larger banks not being significantly in a decline anytime soon in the next, say, couple of quarters. Particularly, we are very convinced about the likes of, say, an HDFC Bank and Kotak Mahindra Bank. Those are the two banks in where we have exposure for our clients in our personal portfolios or for our family, etc. For these two, Kotak and HDFC, past 3-4 years has seen a significant decline in the price to earnings multiples, if you were to put it like that, because their share prices haven't caught up with the sort of 20% plus compounding in their profits that has happened. And there is a massive CASA franchise behind these banks, which comes to light when cost of deposits goes up. Because remember, in cheap cost of deposits, everybody can raise deposits. It's only when the cost of deposits are going up do the boys get separated from the men in terms of the muscle somebody has built to kick off a deposit collection franchise better than their competition, which is where we see HDFC Bank and Kotak being our best bets here.
Okay, so HDFC Bank and Kotak, you remain invested there. Rakshit, hi, good morning. Let me extend that question to what's happening beyond some of these large 4-5 blue chip bank names. I mean, NBFCs, large NBFCs. You guys run, I think, this Kings of Capital portfolio as well, right? Which is largely investing in financials. So what's the approach you're taking? I mean, we're speaking at a time when the benchmark bond yield is at 7.25%. No one's expecting the RBI to cut rates anytime soon. And we've started seeing margin compression, at least with the banks. So what is the approach you will take to financials beyond the key big 5 blue chip names?
Yes, you're right there. And the exposure as a result that we are maintaining in the NBFC sector is where we are very comfortable with the ability to raise deposits and keep growing. Capital adequacy ratios being very healthy, and hence no lack of visibility in the runway of growth of the asset side. So the exposures we have, for instance, are Chola, we've got Bajaj Finance. These are two of the largest NBFC exposures we have. And for these, we don't see, for a Bajaj Finance, for instance, where again, the same disclaimer applies. We've got exposure in our personal portfolios and friends, family, as well as clients. For a Bajaj Finance, we don't see any relenting in the pace of their loan book growth. At least, say, mid to high 20s is the rate at which we expect the loan book to keep growing in the foreseeable future here for the next few quarters. And as long as you've got ROEs of 21-22% there with capital adequacy ratios in the 20s, so on and so forth, I mean, those are very healthy balance sheet numbers to go into an incrementally difficult external environment. Compared to competition, it helps you gain market share.
Picture. I'm so sorry to come in over there, just to kind of press the point. I don't think right now the concern is so much on growth when it comes to financials, Rakshit, but more on margins. So just trying to understand, what is it that you are prepared for? Are you seeing more compression ahead? I mean, should one be prepared to kind of ride out the phase? What happens to profitability as we go through this rate cycle?
Correct. So what we're expecting is some offset between cost to income ratios and net interest margins to sustain the profit compounding here. some erosion in net interest margins should be expected sort of across the board in the lending space in the sort of quarters to come. That shouldn't be ruled out. But this again, I mean, it's very similar to, I think before the break, you were talking about commodity prices moving up and down at different points of time. When margins come under pressure for any company, that's exactly when the strengths of the underlying franchise, they come to light. So cost to income ratios, wherever you see them decline, I think there won't be any challenge in profit growth just because of a 10-20 bips compression in net interest margins there.
Okay, got that. Rakshit, I also wanted your view on what's happening with IT, because a lot of these stocks, of course, after the quarter wasn't so good, we did see cuts come through, but they've recovered from those levels a fair bit. We also have two major IT deals being announced in just a week's time or so, first with HCL, then with Infosys yesterday. Do you think that this is a good place to be in right now? Do you think the worst is sort of in already, or would you expect this kind of caution to persist for a while?
So between deals and deliveries, so as in deal wins are very clearly an indicative of the long-term structural trend, which is favoring Indian IT services, because as there's massive vendor consolidation underway with clouds, applications moving on cloud, data moving to data lake, so on and so forth, this vendor consolidation is going to be needed. You won't be dealing, I mean, let's say a large bank in the US won't be having sort of 10 vendors for 10 different functions in the bank. They will be consolidating all of that, because from HR to, say, finance to some of the operational functions, they will probably have common vendors. Now, common vendors means large-scale manpower, trained manpower required, which, let's say, an Accenture or a Cognizant cannot provide in as great a degree as an Infosys or a TCS can provide. So that's, in a way, to give you a color on how Indian IT services are structurally benefiting, and hence these deal wins are reflective of that, which we expect them to continue. When it comes to deferment of execution of some of these already won deals, that's where I think there will be some separation of boys from the men amongst the Indian IT services as well in the near term. In the long run, we expect the broader sector to see a positive trend from vendor consolidation here. TCS is our top pick here compared to any other company in the Indian IT services space.
Okay. Let's talk also about Pharma, Rakshit, because that's been one space which has surprised on the upside, I mean, pleasantly, at least in Q1. We remember our conversation with Saurabh a couple of weeks back, and beyond Pharma, he was talking about the related healthcare space. I think you guys have been building up positions in some of the diagnostic companies, for instance. So what's the approach? What are the stocks, and would you start looking at large cap pharma as well? I think you also have a position in Divi's, if I'm not mistaken. So are you looking to add on, given what you've heard from the companies this quarter?
Yeah, so there are three kinds of businesses there. One is the health services, which is sort of diagnostics, hospitals, etc. Second is the Divi's kind of B2B pharma space, and the third is the sort of B2C, the standard Indian pharma exporting formulations to the Western world, so on and so forth, which has in the last 2 decades been the flavor of pharma. Amongst these three, it's the first two where we are more excited at a stock specific level, because we see some sort of decimation of pricing power in the third bucket, which is the formulations export. But in the first two, there are some companies which have significant control on the drivers of pricing power in their business model. Divi's, for instance, I mean, the base effect of Molnupiravir is out of the way now. The incremental contract wins are piling up for Divi's. And remember, Divi's is a company where less than half of its growth is from doing more of the same. Half of the growth is through winning new contracts, because particularly on the CDMO side, some of these contracts are from under-patented drugs, and patents have limited time. So the contracts expire and the new ones have to be brought in. We've seen a lot of inflow in the last 1-2 quarters on that front, where new product manufacturing has been put in place. And things like Kakinada plant and all, which they signed up for, wherever they don't need regulatory approval, that kind of a manufacturing shifting to Kakinada, and the old plants which are US FDA approved, doing more of an otherwise capacity constrained manufacturing, which they would have faced without this new plant coming up. So there are many doors which are opening up on Divi's Labs' growth in the sort of months, quarters, years to come, and hence we are quite gung-ho there. Otherwise, yes, you're right on the diagnostic space. It's a very fragmented market. With the largest diagnostic chain being only 5-6% market share, and organized itself is only 20-25% of the market at best. This massive unorganized to organized shift that is underway, that will continue, which should give opportunity to play as an investor into the hands of the best high quality diagnostic players. And then there are some of the there are some hospital companies also which are becoming large format retail equivalents, scaling up the businesses.
Okay, got that. Rakshit, it's always great to have you on the show. Thank you for joining us, and we hope to have you back again and discuss what's going on with the markets. By the way, we are at the